Hello everyone, welcome back to the channel. In today's lecture, we will be touching a new topic. Okay, yesterday we have learned about P&L appropriation account. We have discussed about partnership deeds. Okay, importance of partnership deed. Right? What is the difference between P&L appropriation account and P&L account? Okay, and we have talked about interest on capital, interest on drawings, salaries, and all. Right. So today we will be talking about capital account of partnership firms. Okay, fixed and fluctuating capital. But before that, before we start with our lecture for today, I just want to tell you some points, okay, regarding the previous videos. Now see, we have talked about interest on capital, okay, and interest on drawings. Okay, we know that this interest on capital and interest on drawings will go to P&L appropriation account. P&L appropriation account. Okay, but what about capital? What about capital? What about capital and drawings? What about capital and drawings? Right? We have discussed about interest. Right? We have discussed about interest. But what about the main thing? Capital and drawing. Okay. Now see, this capital is an item of capital account. Okay, it's an item of capital account. It will go to the capital account of a partner. This drawings is also an item of capital account. Okay, now see, you have started a partnership firm at this point. Okay, you have introduced capital. Okay, now what is the journal entry? Cash account, debit to capital account. Okay, this is the journal entry. Now say for example this is 1st Jan. Okay, and 31st December. Okay, now you are carrying on your business. Okay, now at this point on 1st July, say for example, you have done a drawings. Okay, and again August you have done some drawings. Okay, so where will this effect of drawing, where will this drawing go, how will we treat these drawings? Okay, these drawings, what is the meaning of drawing? You have introduced capital into the business. Now out of this capital you are withdrawing the cash. Okay, you are out of the cash introduced, you are withdrawing the cash. Okay, so the direct effect of these drawings will go to the partner's capital account. Okay, so the drawings, you can write this, the drawings will be taken to the capital account of the partners. Okay, because when we withdraw some money, we will be withdrawing from the capital. Okay, our capital will be reduced. Okay, so drawings will, this is point number 1. Point number 2, drawings will reduce the capital of a partner. Okay, capital of a partner. Simple. Now see, why is interest on capital and interest on drawings taken to P&L appropriation account then? Because that is the income or loss for the partnership firm. Okay, so it will obviously be taken to the P&L appropriation account. Okay, I hope this is clear. Now let's move forward with the today's topic. Okay, so the concept which we will discuss today is capital accounts of partnership firms. Okay, fixed and fluctuating capital. Very easy concept. Okay, but students used to face a lot of problem in this fixed and fluctuating capital. Okay, very easy concept. We will understand it in a logical way. Okay, now you can write. Okay, you can write if you want to. Okay, let's start. As the word, okay, as the word, write this down, then after that I will explain. Okay, as the word fixed means what? Means no change. Okay, fixed means no change. Fixed capital accounts also mean that the balance the balance of capital account, are not to be changed. Simple, are not to be changed. Okay, they have to be kept at their initial balance. Simple. Fixed capital account means whatever capital, see, I've told you now, a partner will introduce capital at this point. Say for example, our partner has introduced 50,000 capital. Okay, so if we are maintaining fixed capital account, okay, so whatever he has introduced at this point, 50,000, the balance will not change. Okay, the balance will not change. The balance of the fixed capital account will remain same as the initial capital. Okay, as the initial capital. Okay, but only on one case it will change. Okay, only on one case it will change. What will be the case? If you have if you have made any addition, to the capital account. Okay, if you have made any addition, say for example, you are carrying on business light, we have discussed the concept of additional capital in the basic lecture. Okay, so if there is any additional capital, introduced into the business, okay, then only that additional capital will go to the fixed capital account. Okay, because the balance of the capital will increase, right? The balance of the capital will increase. Okay, now let's continue. The balance of their capital account, are to remain fixed as per agreement among partners. Okay, in order to retain the balance of capital account as fixed, okay, interest on capital account, interest on drawings, goodwill, profit and loss, etc. are not transferred to capital accounts because if these accounts are transferred to capital account, they will definitely change the balance. Simple, right? See, if we are maintaining fixed capital account, okay, whatever the amount of capital, interest on capital the partner is getting, whatever drawings they are making, okay, and whatever the interest on drawings they have been charged, all the salaries, remuneration, all the profits or losses or transactions related to the partner will be not taken into the fixed capital account. Okay, because if we take all these items in the fixed capital account, the balance will definitely change. Okay, so for this we have to prepare one separate account. Okay, will be called as, for this we will prepare a separate account called the partners current account. Partners current account. Okay, simple. So in this I've told you now that interest on capital will go to interest on drawing and interest on capital will go to P&L appropriation account. Okay, so that was from the point of view of the firm. Okay, now see, if interest on capital is a profit for the partner, it is a loss for the firm. Okay, if interest on capital is a profit for the partner, it is a loss for the firm, right? So loss for the firm will be treated in P&L appropriation account. Okay, loss for the firm will go to P&L appropriation account, and we'll have to make treatment for the gain of the partner also. Now if we are making treatment for the loss of the firm, interest on capital we used to write in the debit side of P&L appropriation account. Okay, now interest on capital, who is getting this interest on capital? The partner is getting the interest on capital, right? So we'll have to make the treatment of this interest on capital on the partner's capital account also. Okay, similarly, if a partner has been given has been charged interest on drawings. Okay, so interest on drawings is a gain for the firm. Okay, but it is the loss in the interest on drawing is a loss for the partner. Okay, so if interest on drawings is taken to P&L appropriation account, okay, interest on drawings charged by the partner, okay, charged to the partner, it will be taken to the partner's capital account. Okay, there should be two entries. Okay, double entry. We have to follow the concept of double entry now. I hope you have learned the concept of double entry. Double entry, right? If it is gain for a partner, if it is gain for a firm, it will definitely be a loss for the partner. Okay, so there will be two entries. One will be taken to the P&L appropriation account and the other will be taken to the partner's capital account. Okay, now let's sum up this fixed capital account. Okay, what do you mean by fixed capital account? Fixed capital account. Okay, so if the question is saying that the partnership firm is maintaining fixed capital account, okay, in case of fixed capital account, okay, we will have to maintain two accounts. One is the fixed capital account. Okay, this fixed capital account will only have the initial balance of capital introduced and any additional capital introduced. Okay, and the next account which we will prepare is current account. Okay, now all the transactions related to interest on capital, drawings, interest on drawings, salaries, okay, profits will be transferred to the P&L appropriation, will be transferred to the partner's current account. Simple. If the question asks us to prepare fixed capital account, okay, solve question according to fixed capital account, we will prepare two accounts. One will be fixed capital, okay, the initial, it will have only the initial balance and any additional capital introduced, okay, and all the transactions related to the partner will go to the current account, partner's current account. Okay, I hope this is clear. So now let's see how partner's capital account will look like. Okay, now partner's capital account. Okay, see, this is same, the formula will be same. Okay, formula will be same, particulars, amount, particulars, amount. Okay, now we are preparing partner's capital account. Okay, so capital introduced by the partner is a liability to the partnership firm. Okay, so partner has introduced capital in the partnership firm. Okay, so when this partnership firm will be wind up, okay, the business will be over, okay, cessation of business, this capital introduced will have to be paid back to the partner. Okay, this capital introduced will be paid back to the partner. So the capital which a partner introduced is a liability to the partnership firm. Okay, so now if it is a liability, I've told you in the basic class that all the liabilities, all the assets will have debit balance. Okay, which means increase in assets will be debited and decrease in assets will be credited. Okay, likewise for the liability will have credit balance. Okay, increase in liability will be what? Credited, and decrease in liability will be debited. Okay, so this is the reason why I am telling you to watch the basic lecture. Okay, if you have not yet watched the basic lecture, you please go and watch the basic lectures. Okay, because it's very important. Now see what will happen. This is the partner's capital account. I'm just telling you the partner's capital account. Okay, I'm not talking about fixed or fluctuating. Okay, I'm not talking about fixed or fluctuating. Okay, I'm just telling you about the plain partnership, partner's capital account. Okay, now see, when a partner introduce capital into the business, okay, when a partner introduce capital into the business, this is debit side and this is credit side. So liability will always have credit balance. Okay, so whenever we pass journal entry, what is the entry? Cash account to capital account. See, capital is credited, right? So here we'll have cash account, capital introduced into the business. Okay, now a partner will get what? A partner will get interest on capital. Okay, so interest on capital is a gain for the partner. Okay, and loss for the partnership firm. So if it is a gain for a partner, the partner's capital account will be increased or it will be decreased. If it is a gain for the partner, the partner's capital account will increase. Okay, so the interest will write here to interest on capital. Okay, interest on capital. Now if a partner gets any salary, okay, it is a gain for the partner, but it is a loss for the partnership firm. Okay, so this partner's capital account is for the partner. Okay, we have to prepare this from the point of view of partner. Okay, we had prepared what? P&L appropriation account from the point of view of the partnership firm, but this partner's capital account represents the partner. Okay, it represents the partner, so we have to prepare from the point of view of the partner. Okay, so when a partner gets interest on capital, his capital balance will increase. Okay, likewise when a partner gets salary, okay, salary is a gain for the partner, but it is a loss for the partnership firm. Okay, so if it is a gain for the partner, the partner's capital account will be increased. Okay, so liability account will always have what? Credit balance. Okay, so increase in liability will be credited. Okay, so salary is a kind of liability for the partnership firm, now, because they have to pay this to the partner. Okay, simple. Now if they get any profit, see, when we prepare P&L appropriation account in the previous question, okay, let me tell you. Okay, see, we prepare P&L appropriation account. Now this profit is a what? We have written in the debit side. Okay, it has been transferred to the partner. Okay, so if a partner is getting any profit, his capital account will be increased or decreased? His capital account will be increased. Okay, so we will write the profit at this side. Okay, if there is any loss, we will write it in the debit side. Okay, likewise if a partner has done any drawings, he is withdrawing money from the business for personal use. Okay, so that will what will be the effect of drawings? It will reduce the partner's capital account. Okay, so we will write in the debit side. Remember the rule. Okay, remember the rule. In case of liability, increase will always be credited, decrease in liability will always be what? Debited. Simple. Likewise to interest on drawings will also be debited. Okay, because this will reduce the capital of the partner. It is a loss for the partner. Okay, simple. Now this is how a partner's capital account look like and how will we deal items in the partner's capital account. Okay, so if there is any balance, it will go to balance what? Balance CD. Okay, if this side is more than this side, so the balance will be your balance carried down. Okay, this partner's capital account is an item of real account. Okay, this is an item of real account. I've told you now in the basic lecture that if it is nominal account, the balance, this will not have any balance. Okay, it will be transferred to other account, to P&L or trading account, but partner's capital account is a real account, so the balance will be carried down in the next year. Okay, simple. Now let's talk about fixed and fluctuating capital. Okay, so in case of fixed capital, we'll solve questions. Okay, then we will be it will be much clearer. Now when the question asks us to prepare fixed capital, okay, what will happen? See, partner's capital account. Okay, now say for example partner has introduced 1 lakh rupees as his capital. Okay, so his capital will be cash account. What will be his capital? 5. Okay, and let's say an example, interest on capital allowed to the partner is 10,000, say for example, and interest on drawings is how much? 2,000. The drawings amount is 20,000. Okay, partner has got a salary of rupees 5,000. Okay, and profit is 15,000. Okay, now see, if we are preparing fixed capital account, do you think all these transactions, all these items should be written in the partner's capital account if we are maintaining fixed capital? No, right? Fixed capital means this initial capital, the balance of this initial capital will not change. Okay, so to balance CD, okay, it will not change. See, this capital is not changing, this capital is not changing. Okay, it was 1 lakh and it will be 1 lakh forever. Okay, if there is any additional, we will write here cash additional capital introduced. Okay, nothing more than that. And when the firm dissolves, okay, when the business will over, then we'll have to make an adjustment for this. Simple? Clear? Any doubt? No doubt, right? Now, if we are preparing fixed capital account, the second account which we'll have to prepare is partner's current account. Partner's current account. Okay, now partner's current account. Okay, now the partner's current account, how will we deal the items in partner's capital account? See, partner's current account, all these items, interest on capital, interest on drawings, salary, profits will be transferred to partner's current account. Simple. This will also be same, the rule will be same. All the increases will be written in the credit side and all the losses or decreases will write in the debit side. Simple. Okay, simple. Now if there is any opening balance, we will write the balance here. If not, see, let's now try to treat these items. Okay, interest on capital is a gain for the partner. Okay, so it will come on the gain side, increase side. Interest on capital, how much? 10,000. Interest on drawings is a loss for the partner, so it will go to the loss side. Interest on drawings, okay, 2,000. Now drawings is also a loss because his capital has been reduced. Okay, if he has withdrawn money from the business, that means his capital will be reduced. Okay, so he is getting a salary, so his salary account, his partner's current account will increase. Okay, and if he is getting any profit, again his capital account will increase. Okay, now what do we mean by increase? See, if we write all this increase, all these gains of the partner in the credit side, okay, his balance will increase. Okay, if we add all these things, his balance will increase. Okay, eventually if his balance increases, we'll make the payment according to the figures provided in the P&L, partner's current account. Okay, and this total will be reduced by 22,000 because interest has been charged. Okay, and he has withdrawn some money from the business. Okay, simple. So this is how you will treat fixed capital account. Okay, two accounts will be prepared. First one will be capital account. Okay, it will have the initial balance. The initial balance will not increase, and all the transactions during the year will be transferred to the partner's current account. Okay, simple. Now let's move with the next concept of fluctuating capital account. Okay, fluctuating capital account. Fluctuating capital account. Now, what is fluctuating capital account? The word fluctuating means changing. Okay, so the balance of fluctuating capital account are allowed to increase or decrease. Okay, increase or decrease. Simple. This is why all items relating to partners are recorded in the capital account itself. Simple. So let's again try to understand. Okay, let's again try to understand. Okay, so say for example, these are the items which which a partner has got during the year. Okay. Now see, when the question will ask us to prepare fluctuating capital account, how will we treat? Okay, now we will make partners capital account again. Partners capital account. Okay, so this will be what? Particulars amount, debit side and credit side. Again, I will repeat. We all know that capital is a liability for the partnership firm. Okay, so it will have credit balance. All the increases or gain for the partner will be written in the credit side. All the losses or decrease in the partner's capital will be written in the debit side. Simple. And partner's capital account will be prepared from the view of partner. Okay, this is an account of partner, so we will prepare from the viewpoint of partner. Okay, P&L appropriation account, profit and loss account will be prepared from the point of view of the partnership firm. Simple. Now see, what was the opening balance of capital account? 1 lakh. Okay, in our previous example. Now by cash, say for example he have introduced cash of rupees 1 lakh. Okay, now we are preparing capital accounts as per fluctuating account. We are preparing fluctuating capital account. What do you mean by fluctuating? Means changing. Okay, so all these transactions, all these items, all these gains or losses which the partner has got during the year will be written in the main partner's capital account itself. Okay, simple. Now he has got interest on capital. Interest on capital is a gain for the partner, so it will be written on the credit side. Interest on capital, how much? 10,000. Interest on drawing is a loss, to interest on drawings. Okay, how much? 2,000. To drawings is also a loss. Okay, it will reduce the capital balance. 20,000. By salaries, his partner is getting a salary, it's a gain for the partner, so it will increase his capital, and he is getting profit, so profit will also increase his capital, so it will be written in the credit side. Okay, now what you have to do, you have to add all these items. Okay, see, we have to check whether which side is higher. Okay, so 1 lakh plus 10,000 plus 5,000 plus 15,000. So the total of this side is 1 lakh 30,000. 1 lakh 30,000. Okay, now you see this side, the total of this side is how much? 22,000. Okay, so the gain side is much higher. Okay, so we will have to write the balance on the debit side. Balance BD. How much is the balance? 1 lakh 30 minus 22,000. See, 1 lakh 30 is the gain and 1 lakh 22 is the 1 lakh 30. With 1 lakh 30,000, the partner's capital account, the credit balance is 1 lakh 30 and the debit side is 22,000 because he has withdrawn 20,000 and interest is charged 2,000 rupees. Okay, so what will be the balance? The balance will be 1 lakh 8,000. Okay, 1 lakh 8,000. Okay, so we will close the partner's capital account. Simple. So this is how we treat partner's capital account in case of fixed and in case of fluctuating. Okay, if I have to sum up, in case of fixed capital account, we will prepare two accounts. Okay, one is partner's capital account and the other one is partner's current account. Simple. Partner's capital account will only have the initial capital. Or any additions made will go to partner's capital account. Okay, and all the items related to a partner, okay, all the gains or losses of a partner will be taken to the partner's current account. Simple. And in case of fluctuating, okay, we'll prepare only one main partner's capital account. All the items will go to this partner's capital account. Simple as that. I hope It is very clear to you. Okay, so now we will solve questions relating to fixed and fluctuating capital. Okay students, so now let's solve question number 4, page number 53. Okay, so let's read the question. This will be related to fixed and fluctuating capital. Okay, so A and B are partners of a firm sharing profit and losses in the ratio of 3:2. Okay, now we have been solving questions where the profit sharing ratio was not mentioned in the partnership deed. Okay, so we used to share it equally. Okay, now we have been given the profit sharing ratio. Okay, what is the profit sharing ratio? 3:2. Their capital were 60,000 and 40,000 as on 1st Jan 2014. A has introduced 60,000 and B has introduced 40,000 on 1st Jan 2014. Okay, during the year they earned a profit of 2,50,000. They earned a profit of 2,50,000. So this 2,50,000 will be distributed between A and B in the ratio of 3:2. Okay, according to their partnership deed, both the partners are entitled to rupees 800 per month as salaries. Okay, both are entitled to how much? 800 per month as salaries. Entitled means their right. Okay, who has given the right? The partnership deed. Okay, see, the first one is clear. Salary has been given, profit sharing ratio has been given, salary has been given. Okay, and interest on capital and 5% interest on capital. Okay, so the third point is also clear. Profit sharing ratio is given, salaries is given, interest on capital is given 5%. Okay, and they are to be charged interest at the rate of 5% on their drawings. Okay, they are charged 5% interest on drawings. Okay, so all the four items, okay, has been given. Profit sharing ratio is given. Okay, and salary is given. Okay, interest on capital is given and drawings is given. Okay, now on the drawings, which is 12,000 for A and 8,000 for B respectively for the period. Now what is this amount? This amount is of 12,000 and 8,000 is the amount for drawings. Okay, this is the amount of drawings and we have to calculate interest on drawings from this amount. Okay, simple. Now let's try to solve this question. Okay, what is the requirement of the question? We have to prepare partners capital account when capital account are fixed and capital account are fluctuating. Okay, so let's start preparing our capital account. Okay, so the first requirement was preparation of solution, preparation of partners capital account, preparation of partners capital account when what is number 1? Capital account are fixed. Capital account are fixed. Okay, so we have to prepare partners capital account of partners. Okay, now we'll prepare separate capital account for each partner. Okay, we'll prepare separate capital account for each partner. In the future questions you will see that when you prepare your partners capital account, say for example in case of admission, retirement, debt, okay, you will prepare one capital account for all the partners. Okay, we will discuss that later on. Now we will prepare separate capital account. Okay, now capital account is fixed. Okay, now in case of capital account fixed, what we used to prepare, we have to prepare two capital account, right? We have to prepare one capital account and we have to prepare one current account. Okay, so let's prepare AS capital account first. AS capital account, particulars, amount, particulars, amount. This will be debit side and this will be credit side. Okay, so capital account are fixed, right? So when capital account is fixed, okay, we will only have what? We will only have the capital amount. We'll only write the capital account. We'll only write the capital amount. Okay, so this capital account we are preparing at the year end. Okay, we are preparing at the year end and capital has already been introduced on 1st Jan 2014. Okay, capital has already been introduced on 1st Jan 2014. Okay, now we will have here what? By balance BD. Okay, so what is the amount? For A, 60,000. Okay, for A is 60,000. Simple. Okay, now will fixed capital account have any other thing? No. Okay, so this balance will be the to balance CD. How much? 60,000. Okay, it will be 60,000. See, the question has not said. You may say now, why did you write balance BD? Why did you write balance BD? Why did you not write capital cash account? Because see, the question is saying their capital account where. Okay, their capital account where the balance of capital account, they have already introduced the capital. Okay, so cash will not come here. Okay, they have already introduced the capital and the cash entry has already been made. Okay, on 1st Jan 2014. Okay, so we have to write the entry this way. 60,000. 60,000, simple. So as capital account is done. Now all the transactions, all the items which A is getting, it will be taken into the current account. Okay, simple. So let's prepare as current account. As current account, same, debit and credit. Okay, debit and credit. Is there anything mentioned about the capital balance of the current account? Any balance of the current account? No, nothing has been mentioned regarding the balance of the current account. Okay, this balance is of capital account, so it will not have any balance BD. Now let's start with the first item. Okay, see, during the year they earned a profit of 2,50,000. They means A and B. Okay, so this profit will be divided between A and B in the ratio of 3:2. Okay, so let's calculate working note number 1. Okay, calculation of, write this way, division of profit. Division of profit. Okay, between A and B. What is the profit amount? What is the amount of the profit? 2,50,000. Okay, 2,50,000. Okay, and what is the ratio? See, the ratio of 3:2. A and B will share the profit in the ratio of 3:2. Okay, 3:2. Out, see, what is the total? 5, right? 3 plus 2 is 5. So A will get 3 out of 5 and B will get 2 out of 5. Okay, into 3 by 5, and B will get 2,50,000 into 2 by 5. Okay, so what is the amount? 2,50,000 into 2 divided by 5 will be 2,50,000 divided by 5 into 3 will be 1,50,000. Okay, 1,50,000, and this will be how much? 2,50,000 into 2 divided by 5 will be 1 lakh. Total is 2,50,000. So A is getting 1,50,000 and B is getting 2,50,000. Okay, so first let's write all the working notes. Okay, let's write all the working notes. Then after that we will prepare as current account and capital account. Okay, now see, next, according to the partnership deed, both the partners are entitled to how much? Salary of 800 per month. Okay, both are entitled, both will get 800 rupees per month as salaries. Okay, see, this is per month, so 1 month he will get 800. So during the year there are 12 months, so he will get how much? 800 into 12. Okay, so working note number 2 will be how much? Calculation of salaries. Okay, so in case of A, how much? 800 into 12. B will also get 800 into 12. How much will A get? 800 into 12 will be 9600, and B will also get 9600. Done. Now interest on capital will be 5%. Okay, interest on capital will be 5%. So what will be the working note number 3? Calculation of interest on capital. Okay, interest on capital will be, what's the rate? Will be 5%. Okay, so A has introduced 60,000, B has introduced 40,000. Okay, A has introduced 60,000 and B has introduced 40,000, and the rate is, what's the rate? It is 5%. Okay, they are getting 5% interest per annum. 5%. Okay, so 60 into 5 is 3,000. Okay, 3,000, and 40 into 5 is 2,000. Simple, clear? Now next thing, they are to be charged interest at the rate 5% on their drawings. Okay, on their drawings they have to charge, they are being charged interest at the rate 5% on their drawings, which is, see, the question is telling us the drawings amount. Okay, drawings amount is A4. Now let's take working number 4, calculation of interest on drawings. Okay, what is the amount of drawing for A? 12,000 and for B is 8,000. Okay, so they will be charged how much? Interest at the rate 5% for 1 year. Okay, because see, this is during the year. The question has tell us that during the year. Okay, during the year, and they have been charged interest of the period, irrespective of the period. Irrespective of the period means they have been charged for the whole year. Okay, so what is the amount? 12,000 into 5% is 600 for A, and 8,000 into 5% is 400 for B. Okay, and what is the drawing amount? Drawing amount of A and B. A is 12,000, B is 8,000. Simple. Now we are done with the working note. Okay, now let's try to prepare the capital and current account. See, we have prepared as capital account, so this we are preparing as per fixed capital account, so the balance will not change. Okay, and all these things will come to capital account. Okay, so see, division of profit. Profit is a gain or loss for a partner. It is a gain. Okay, so all the gain will come on the credit side. Okay, all the gain will come on the credit side. Okay, by profit and loss account, net profit. Okay, what is the amount? A, 1,50,000. Okay, next B, for B we'll calculate later on. Okay, we'll prepare the account later on. Now calculation of salaries. See, A is getting salary of 9,600. Okay, so you can write here working note number 1. Okay, now salary is also a gain for the partner. Salaries account, you will say working note number 2. So what is the amount? 9,600. 9,600. Simple. Next is interest on capital. A is getting interest on capital. It is a gain for the partner. Okay, so we will write in the credit side. Okay, by interest on capital, you can say working note number 3. Okay, what is the interest amount? 3,000 rupees. 3,000 rupees. Okay, now next, see, interest on capital is done. Interest on drawings and drawings amount, these two we have to provide for interest on drawings and drawings account. Okay, so drawings is basically what? Drawings will reduce the balance of the partner's capital account and current account, right? So it will be written in the debit side. Okay, to drawings and to interest on drawings, to interest on drawings. You can say working note number. What is the working note number for drawings? It is 5, and for interest is 4. 5 and 4. Okay, so what is the drawing amount for A? 12,000, and interest amount is 600. 12,000, and C, interest amount is 600. Okay, 600. Now we are done with all the transactions. Okay, so now what we'll have to do, we'll have to find out the balance amount. Okay, so balance of the account. So see, here he got 1,50,000 as his profit, 9,600 as his salary, and 3,000 as interest. So we'll have to add all this. Okay, 1,50,000 plus 9,600 plus 3,000. So the total is how much? 162600. Okay, so out of this we'll have to reduce 12,000 because his capital has been reduced, and we have to reduce interest on capital 600. Okay, so what will be the balance amount? The balance amount will be, to balance CD will be how much? 1,50,000. Okay, so this is your answer. Okay, so we have prepared as capital account and as current account. Okay, so if you want, you can note this down. Pause the video and note this down. Okay, so this is the divisible profit amount in case of A, and this is the interest on drawings and drawings amount. Okay, so now let's prepare B's capital and current account. Okay, B is capital account. See, I will not write particulars amount every time. Okay, so in exam you just don't simply write this account this way. Okay, you will have to write properly particulars amount, particulars amount. Okay, this will be the debit, this will be credit. If you don't write this debit and credit also, it's fine. Okay, now capital account, we are preparing fixed capital account. Okay, so nothing will change. Okay, by balance BD, what is the amount? 40,000. Okay, he has introduced, B has introduced how much? 40,000 as his capital. Okay, we has introduced 40,000 as his capital. Simple. So this account will be closed the way it is, balance CD. Okay, no changes will be done because we are preparing fixed capital account. Now all the items will be written in the current account. So we will prepare B's current account. Okay. Is the question mentioned? Has the question mentioned anything about the balance of current account? No, nothing has been mentioned. So there will be no balance. Okay. So now let's start with working note number 1. See, B is getting a profit of 1,50,000. Okay. So we'll write here, see, debit side and credit side. Credit side is for the gain side. We'll write here by profit and loss, net profit. Okay. Working note number 1. What is the amount? 1 lakh. 1 lakh, right? See, 1 lakh. Now salary he is getting 9,600. Okay. Again, salary will be written at this side by salaries. Working note number 2, 9,600. Simple. He is getting interest on capital by interest on capital. You can write working note number 3. What is the interest on capital? 2,000. Okay. 2,000. Now next, drawings and interest on drawings. Okay. So to drawings will reduce his balance. So we will write in the debit side to interest on drawings. Okay. So what is the amount of drawings? See, 8,000. 8,000. And what is the amount of interest? 400. Okay. 400. You can write working note number 5, working note number 4. Okay. Simple. Now nothing else is left. So we will find out the balance. Okay. So to balance CD, what will be the balance amount? See, this is the profit side. You will add all this, 1 lakh plus 9,600 plus 2,000. Okay, and you will reduce this. 8,000 minus 400 will be, the balance will be 103200. Okay. $111,600. Okay. So this is all about fixed capital account or fixed. Okay, we have done this number 1. So let's do the number 2 question. Requirement number 2 is we have to prepare capital account as per fluctuating capital account. See, capital account are fluctuating. Okay, so let's do number 2. Capital accounts are fluctuating. Capital accounts are fluctuating. Okay, as capital. Now when capital accounts are fluctuating, all the items will be written in the capital account. All the items will be written in the capital account. Basically, what will happen? This capital account and this current account will be merged together. Okay, it will be merged together. Now see, what was the balance of the capital account? 60,000. Okay, so you write the balance by balance BD 60,000 by balance BD 60,000. Okay, and he got profit and loss. How much? 1,50,000 by salaries 9600. This will be P&L appropriation account. Okay, because we have prepared partners in P&L appropriation account now, so the balance will be transferred from P&L appropriation account. Okay, APP account. Salary is 9,600 and he got interest on capital 3,000. Wait, some mistake. I've done some mistake, I guess. 150, 9,600. Okay, it's fine. 3,000. Simple. See, I have not done anything. Okay, I've just balance BD is this. Balance BD is this. Okay, I have taken this. I've taken this. Okay, so these two accounts will be joined. Okay, we'll have to prepare one account when it is fluctuating because all the items will be taken in the P&L in the capital account only. Okay, so now we can. At this side, at the debit side, we will have to write the drawings. What is the amount of drawings? 12,000. What is the amount of interest on drawings? 600. Now the balance will change to balance CD. Okay, so you add all this. How much did you get? 60,000 plus 1,50,000 plus 9,600 plus 3,000. Okay, so the total is 222,600. Okay, and you have to less 12,600. Okay, so what is the balance of the capital account? 2,10,000. Simple. So we have prepared capital account of A when it is fluctuating. Okay, now we'll prepare B's capital account. B's capital account. Okay, now what we'll have to do again, we'll have to make one account. Okay, all the items of both the account will go to one account only. Okay, so let's start. First one will be capital of balance of capital account by balance BD. How much? 40,000. Okay, by P&L appropriation account. How much? 1 lakh. C 40,000, 1 lakh, 9,600 and 2,000. Okay, by salaries is 9,600, by interest on capital is 2,000. Simple. And this side, two drawings, 8,000. Okay, to interest on drawings 400. Okay, so with the balance we'll get is 143200. Okay, so you add all this part, you add all this. How much did you get? 1,40,000 plus 9,600 plus 2,000. Okay, so 151600. Okay, and you less all this, 8,000 minus 400, you get this answer. Okay, 143200. So this is all about fixed and fluctuating capital. Okay, so this may come in your exams as well. Okay, it's very important concept. Student used to be very confused. Okay, it's very simple. You don't have to be confused.